Today we're going to talk about debt to income ratio for your mortgage, how to calculate it, and how it can affect your mortgage approval. And we're getting started right now. Hey, what's going on? I'm Emmett Dempsey, mortgage advisor with Geneva Financial here in beautiful Port St Lucie, Florida, and welcome to another mortgage and home buying tip. If this is your first time here and you want to learn more about mortgages or the home buying process in general, go ahead and subscribe to my channel and ring that bell so you don't miss anything. Okay, the debt to income ratio for your mortgage. I'd say that this calculation is probably the most important thing that I do as a loan originator to know exactly how much home you get qualified for, or even whether you qualify at all for a home loan. So I'm going to go into exactly the things we use in the calculation on the debt side, on the income side. So knowing exactly what those things are and the things that we include and don't include are very, very important. So first, as a general rule of thumb, 50% is basically usually the maximum. I can go a little bit above 50 when we talk about debt to income ratios as far as the maximum. But let's go ahead and talk about what we include in debts. As far as what we do include in debts, basically your car payments and your revolving credit card accounts, usually on your actual trade lines that we count. We don't count utility bills or anything of that nature. Usually what's on your credit report, namely your car payments and your revolving credit card bills. Also, as far as if you pay child support or alimony, or you're obligated to pay payments, or back taxes of that nature, anything that you have to pay for 3 years or more, with including your debt to income ratio. Also, there's some special things that we have to include, and that really depends on the loan type. And I did a FHA versus conventional video. You can find it here in the info card here to check it out. But basically, student loans and collections. Student loans, usually I have to include a 1% payment if you're on an income-based repayment plan, or I'll use the fully amortized payment. But if you have deferred student loans, you can no longer ignore them. You have to have a payment calculated for them. So FHA, it's mandatory 1% no matter income-based repayment. Conventional loans allows you to use zero if in fact you are paying zero. FHA has a guideline for collections. If you have more than $2,000 in collections, I have to count a 5% payment for that. So basically, you add up all your collections that are bad collections, you can't just ignore those either. So that can hurt your debt to income and can lower the amount of house that you can buy. Okay, so let's talk about the income side. Usable income is a key factor. Usually there's your base pay, or it's bonus and commission. So when I talk to you, I'm going to really drill down and say, how in fact are you getting paid? Well, I get paid X per month. I say, well, how is it getting paid? Is it base plus commission? Is it base plus overtime? So that's very, very important about how we find usable income. That we can use. So generally, say you make $20 an hour, you do $20 an hour times 40 hours a week times 52 weeks a year divided by 12. So if you get paid biweekly, it's 26 pay periods, and that's how we find it. So we'll look at your base pay. If you have overtime or bonus for 2 years, we can use an average. Of course, self-employment will do its own calculation, usually a 2-year average for that. So basically, you take all of your debts, divided by your income, and that's how you come up with your plus your new mortgage payment equals your new debt to income ratio. And you might have heard the terms front end and back end. The front end is your new mortgage payment. That's principal, interest, taxes, insurance, any HOA bill for that property that you're buying, and that's your front end ratio. Usually they like to keep that down below 31% or so. But you can go higher in FHA. And then there's the back-end ratio. And then usually that's the ratio that ultimately determines what your total debt-to-income ratio is. So that we try to keep that down below 50. Some FHA loans, I can go into 55, 56. I've gotten some approvals. All depends on other compensating factors. So that, in a nutshell, is the debt-to-income ratio. You want your own personalized analysis, and when you talk to me for your own pre-approval analysis, go to DempseyMortgage.com or give me a call. Shoot me a text, 772-618-5058. To get your own pre-approval analysis so we can know exactly what your DTI is. I really appreciate, I would love the opportunity to help you and your family buy your next home, get you your next refinance. And again, if you want to learn more about mortgages and the home buying process in general, go ahead and subscribe to my channel, ring that bell so you don't miss anything. Thank you so much for watching, and I'll see you on the next one.